In this video I'm going to be discussing staying in the trade. So some ideas, 7 ideas actually, how to stay in the trade. So often we can get into a position, you can maybe be in the money in terms of the position is looking profitable, and the market conditions may change a little bit on the shorter time frames. You can be and the market may be going against you, but you've got to stop in place and everything else, but you decide, am I going to come out of this trade? So here's the 7 ways of staying in the trade. Firstly, revert to the higher time frames. Most easiest way to do it, and my preferred way of looking at the market, is from the higher time frames. So if we just bring the chart into play, and here we go. So staying in the high time, let's just say we're short from a bigger picture, and this is starting to happen. It does come back off. I just wanted an example of where you're short and it's starting to go against you. Okay, so it's starting to go against you. So if we look up the time frames and see what it was doing, that's a 60-minute, a 4-hourly. What's it doing? Okay, so this is what it was doing at the time, and yes, it was looking a bit, looking like it was going to move up. But also look at the resistance points. Check everything that's sitting there. Resistance across these prior highs, and yes, if it breaks that, it could well be, well, curtains in terms of where you are. However, it wasn't. And if you've got up in these higher levels here and in this position, you've got to think about holding on there. The risk is that you just come out because of some noise. Look at the dailies. What's the dailies telling us? Well, that's very much a southbound journey at the moment. So that's certainly showing us that. And come up to the weeklies. What's the weekly? Well, the weekly really is suggesting the market is on the downside. It's a lot easier to be on the downside or in the trend than against the trend. So absolutely perfect what it's doing here. Okay, so that's it. Just come up the time frames. So let's move back. Then stick to your target. It's almost the same thing, but it's not. It's not. Sticking to your target is just purely that. You're just going to be looking at your target and staying with what you was actually setting out to do in the first place. Why would you do anything but stick to your target? If you've got a target, if the target's right, then in that case, stick to it. That is it. The target is the target. There's no point going on beyond that. Stick to it. Great way is to walk away from the screens. Walk away, keep away, don't be looking. Walking away from the screens is probably the most profitable thing you can do once you're in the trade. If you get into a trade, or if you put orders in for the trade, just put everything in and walk away. Sitting at your trading desk all day long is probably bad for your balance. One, you want to get into, you may be looking to get back into a trade if you've been stopped out of it. Or 2, you want to fiddle. You see things, and walking away from the screens is the best way of staying in that trade. I've talked about sticking to your target. Ensure you have a logical target. It is important that you have a methodology to ensure that target's achievable. I've talked about targets on a recent video. You can have a look at that. If I remember, I'll put the tag up there for you to look at logical targets. But a logical target may be an equal throw in terms of a flag pattern or something. That's just look at what I'm referring to here. So if you've got a movement up and you've got a flag, for example, you just simply measuring the range, applying that onto the low once it starts moving up wherever you're getting in for it to, and applying the same distance across. Equal throws, logical target. Maybe a pivot, logical target. Whatever it might be, a moving average, whatever it is, it's still a logical target. So ensure that you have a logical target, and then you'll feel easier with it. Okay, read the price action. Read the price action on the higher time frames more so than the lower time frames, because we will see that on the short time, 5 minutes, even an hourly or 4-hourly on that euro example, there were higher lows coming through there. So it can be a little bit concerning at times. But just because there's a higher low doesn't mean say everything's changed. It is on the short term. But read price, come out and look at it on the higher time frames. Again, it's a combination of the two. But read what it's doing. If it's constantly putting higher lows in and it's starting to break the opposite direction, well, you might just be wrong. But still, stick to your target. If you put the stop and everything in the right place, just stick to your target. Okay, another one, it's a bit like walking away from the screens here. Don't look at the money, look at the chart. So many people will have their brokerage open and will be watching not just the price action going on there, but more so that looking at how many pips they've made or how much money. I always prefer to see, if I'm using the MT4, I'll leave it in pips, because I'm more interested in knowing how many pips it's moved than what it's actually given me in monetary terms at any stage. It's more important. But at the end of the day, the best thing is to have it closed down or just minimized, so you're not actually looking at it. So that'll keep you staying in the trade, because if you see too much money there, you might be wanting to take it and leave half of it on the table. Okay, the final one here then is ensuring you're giving it room. Use sensible stops. If you're trailing the stop, make sure it's not overly trailed in terms of too close. There are times when you might be wanting to get aggressive with the stop, because it's getting to a point where you had a loose target, you had an area where you thought it was going to go to, it's broken through that, and you're in for the ride. That's great, but you want to try and stay in the position as long as you can, but by trailing the stop carefully, so you might get stopped when it turns around, puts a higher low in and starts breaking up, then your stop might be taken out. But ensure that you give it room. Don't be using little tiny stops, because you'll be stopped quickly. The bigger the stop, the more chance you've got of staying in the trade. But at the same time, don't give it so much room that just to be right, which is a thing that many people do. So give it room. So there you are. Revert to the higher time frames, stick to your targets, walk away from the screens, ensure you have a logical target. If you're a bit nervous, make sure you can understand why you're aiming for something, regardless of what it may be. Read the price action. If you're starting to feel a bit iffy, read the price action, but look at the price action on the higher time frame. So it really is going back to reverting to the higher time frames there. Do not look at the money, look at the chart. The chart is where it's all at. If you start looking at the money, you start seeing it reducing, temptation is to close the trade, and then you know what happens next. It rolls over and pushes up, and it makes what would have been a great trade. And finally, ensure that you're giving it room. Make sure that you stay in the trade, because you're not pushing and starting off with stops so tight it's going to be stopped out very quickly. There you go. Hope you find that useful. Take care.